Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over self-employed and small business retirement plans. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training where we go over the key ingredients to passing the CPA exam. Again, it's free, and it's only 1 hour long, and we will save you so much time struggling with your process. Definitely go check it out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more practice and more videos if you become a Superfast CPA member. This is the last video of a short group of videos where we were talking about different retirement plans, and this has a whole bunch of different ones kind of smushed together in the same video, so let's go ahead and get straight into the questions. Okay, here is question 1. Chris, a self-employed, decides to contribute to his Simplified Employee Pension or SEP IRA in the current year. His net earnings from self-employment amount to $200,000. For the current year, the maximum contribution an individual can make to an SEP IRA is the lesser of 25% of compensation or $65,000. Calculate the maximum amount Chris can contribute to his SEP IRA for the current year. Okay. Pretty much it told you how to do the calculation right there in the question, and to be honest, that's kind of going to be the case with a lot of the questions in this video because, again, I don't typically try to teach the exact numbers for the year or different things like that because that changes so much, but because in this video we're going to be learning a lot about the different limitations for these retirement accounts, a lot of the questions are going to tell you what the limitations are right at the beginning because they are different than the typical limitations because, again, those change each year. So you can probably do this, pause the video, do the calculation, and when you're ready, come back, we'll look at the answer and start learning how SEP IRAs work. Okay, and the answer is $50,000. And before we dive into this big explanation, the second paragraph says, in this question, 25% of Chris's net earnings from self-employment, which is $200,000, would be $50,000, which is less than the maximum limit of $65,000, making that the allowable max contribution. But let's learn what SEP IRAs are in the first place. A Simplified Employee Pension, or SEP IRA, is a retirement plan primarily designed for self-employed individuals and small business owners. And by the way, that's going to be the case for pretty much all of the retirement things we look at in this video. It stands out for its simplicity and higher contribution limits compared to traditional IRAs. Employers can contribute up to 25% of an employee's compensation or a specified maximum amount, whichever is less, directly into each employee's SEP IRA, including themselves if they're self-employed. This is significantly higher than the contribution limits for traditional and Roth IRAs. Unlike 401k plans, SEP IRAs do not allow employee contributions and are solely funded by employer contributions. This makes them particularly appealing for small businesses that seek an easy-to-manage retirement solution without the administrative complexities and costs associated with more traditional pension plans like 401ks. Also, SEP IRAs offer flexible annual contributions, meaning employers can decide how much to contribute each year based on business profitability. So SEP IRA, basically, depending on how well the business is doing, the employer can contribute to this IRA for the employee, but the employee cannot do any contributions of their own. But it's really simple, and that's kind of the idea or the appeal of it is it's simple and it's easy for self-employed individuals or small business owners to use and do. So that's one of the retirement plans we're going to look at. Let's go to the next one to learn about a different retirement plan. Okay, here is question 2. Samantha owns a small design studio with 3 employees. She is looking for a retirement plan that is easy to administer, cost-effective, and allows both employer and employee contributions. Her business has steady but moderate profits, and she seeks a plan that would encourage employee participation in retirement savings with a match from the business. Considering the options of a 401k, an SEP IRA, and a simple IRA, which retirement plan would best suit Samantha's needs? So we just barely learned about SEP IRAs, and I'll just say it right away. We already know that SEP IRAs don't allow employee contributions. So it's between a 401k or a simple IRA, or maybe even neither of them. We're not 100% sure. So let's go ahead and dive straight into the answer to learn which of these would be best for Samantha. And it looks like it would be a simple IRA. The simple IRA, or Savings Incentive Match Plan for employees, is ideal for small businesses like Samantha's due to its simplicity and lower operational costs compared to 401k plans. It also allows both employee and employer contributions, different than an SEP IRA. with employers either matching employee contributions up to 3% of compensation or contributing 2% of each eligible employee's compensation regardless of the employee's contributions. This plan supports Samantha's goal of encouraging employee savings while managing business costs effectively, making it more suitable than the SEP IRA, which does not allow employee contributions, and the 401k, which is generally more complex and expensive to administer. Just a couple more things about a simple IRA. It is designed specifically for small businesses, again, just like everything we're going over in this video, with 100 or fewer employees who receive at least $5,000 in compensation during the preceding year. Employees can only contribute a certain amount. For example, in 2024, it's $15,500, with an additional catch-up contribution allowed for those aged 50 and over. Again, in 2024, it's $3,500. So just another option for smaller businesses. Instead of having to pay for a big 401k plan, they can do a simple IRA if they still want their employees to be able to contribute. Let's go to the next question. Okay, here is question 3. John, a self-employed architect, operates his business as a sole proprietorship and has elected to use a Keogh plan. By the way, I had no idea how to say that before this. I had never said it out loud, but I looked it up and supposedly it's Keogh. And so he's using a Keogh plan, defined contribution, for his retirement savings. In the current year, John reported a net profit of $260,000 from his business before considering any contributions to his retirement plan. According to the IRS regulations for the current year, the maximum contribution limit for a Keogh plan, which is again a defined contribution Keogh plan, and we'll learn about that in a second, is the lesser of 25% of compensation or $66,000. Calculate the maximum contribution John can make to his Keogh plan for the current year. Okay, again, calculation is pretty easy because we pretty much gave it to you right there. The idea behind all these questions is to teach you all about these different retirement plans, not just to have challenging questions. Because again, with SuperfastCPA, the questions are your learning material. So whether it's a hard question or an easy question, you're learning from each question. So go ahead, pause the video, do the calculation, and when you're ready, come back, we'll look at the answer and learn more about Keogh plans. Okay, the answer is $65,000. Again, probably not too hard to calculate. The calculation for a Keogh plan defined contribution for a self-employed individual involves first determining the net profit and then applying the contribution percentage. In this scenario, 25% of John's net profit, which is $260,000, would be $65,000. Although the limit is $66,000, John's calculated contribution based on his net profit is the lesser amount, hence it's $65,000. So again, it's the lesser of the 25% or just that number, that $66,000. And again, that $66,000 could be the current year number, but don't pay attention too much to that because it changes with each year, so you'll just have to know that from your current review course or just look it up. A Keogh plan, also known as an HR 10 plan, is a retirement savings option designed specifically for self-employed individuals and their employees in unincorporated businesses, such as sole proprietorships and partnerships. These plans allow for higher contribution limits compared to other retirement accounts, making them attractive to high-earning self-employed professionals. There are two main types of Keogh plans, defined contribution plans and defined benefit plans. Just letting you know, for the CPA exam, you're most likely going to be focusing on defined contribution plans if you even see anything about a Keogh plan. Defined benefit Keogh plans promise a specific retirement benefit calculated based on factors like salary and years of service, similar to traditional pension plans. Defined contribution Keogh plans, such as profit-sharing plans and money purchase plans, specify the contribution rate but not the final benefit, which depends on investment performance. So, yet again, another different type of retirement plan for self-employed or small business people. There's two different types, but again, you're mainly going to be focusing on defined contribution plans. And that's a little bit about Keogh plans. Let's go ahead and go to the next question. All right, here is the next question. Which of the following is not an advantage of a Keogh plan? All right, we learned a little bit about this in the previous question, but you still might not know too much. If you want, go ahead, pause the video, see if you can think through this. But if not, let's go ahead and go to the answer. Okay, and the answer is that lower administrative costs and simpler setup compared to 401k plans is not an advantage of a Keogh plan. Keogh plans, particularly defined benefit types, typically involve more complex administrative requirements and higher costs than many other retirement plans, including 401ks. This makes them less advantageous for those seeking a low-cost, easy-to-manage retirement solution. So it turns out Keogh plans, while they are for self-employed or small businesses, they're more for high-earning self-employed individuals or businesses because they're not that cheap. They're still kind of complex, unlike SEP IRAs or simple IRAs where it's a little bit easier, which is the point. So we learned a little bit more about Keogh plans there. Let's go to the next question. Okay, here is question 5. Martin, age 59, owns a consulting firm and participates in a defined profit sharing plan or DPSP. His annual compensation is $95,000. The IRS stipulates that the maximum contribution to a DPSP is the lesser of a specific percentage of an employee's compensation, or $67,500, which includes a $7,500 catch-up contribution for those aged 50 and over. So basically, by the way, right there it's saying $67,500 is actually $60,000 plus that $7,500 catch-up contribution. What is the percentage of compensation used in this calculation? Okay, so this is something new, a defined profit sharing plan. So what is the max contribution? We've seen like 25% of compensation or a specific number. Is that how it is for a DPSP? Maybe. Let's go ahead and dive in and see what the difference is, if there is a difference for a DPSP. Okay, turns out that a DPSP, it's actually 100%. So again, let's read through this. The maximum contribution limit for Martin's DPSP is the lesser of 100% of his compensation, or $67,500. Although his compensation is $95,000, the limit, including the catch-up contribution for those aged 50 and over, is $67,500, which is less than his total compensation. Hence, $67,500 is the maximum amount he can contribute this year. So a little bit different. The previous ones where we've seen something like this, where it's a percentage of compensation or a number, the lesser of one of those. In this case, it's 100% of their compensation or that specific number. So let's read about DPSPs. A deferred profit sharing plan, or a DPSP, is a type of employer-sponsored retirement plan that allows businesses to share profits with their employees based on companies' earnings. Contributions are made by the employer only and are discretionary, meaning they can vary from year to year depending on the company's profitability. The contributions are tax deferred for employees, meaning they are not taxed until withdrawn from the plan. Typically at retirement, DPSPs are particularly beneficial for businesses looking for flexibility in how much they contribute annually, allowing them to align retirement benefit contributions with their financial performance. This makes DPSPs a valuable tool for employee motivation and retention, as employees directly benefit from the company's success. So this is another type of retirement plan option where it's actually the company, based off of their success, sharing some of their profits for their employees' retirement. But it's discretionary, so they can choose how much to do, and it is limited to a specific number or to how much compensation the employee makes. It's the lesser of those two. So we've learned about a whole bunch of different retirement plans in this video. These are kind of like all the leftovers from the previous 3 videos. So let's go ahead and do one more part of the process before we do anything else, called pillar topics. Now, the idea behind pillar topics is, as you're going through questions to learn the material, you will notice things that keep popping up. These are topics, calculations, equations that keep popping up. You see them in like 4 or 5 questions, and you know that they're obviously important because your review course is trying to teach you them so much. So you write down these pillar topics so that you can know them for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off, SEP IRAs allow employers, including self-employed individuals, to contribute up to 25% of an employee's compensation or a specified dollar cap, and that kind of was continual throughout all of these. And so, for example, $66,000, whichever is less, directly into an IRA established for each employee. Simple IRAs are designed for small businesses with 100 or fewer employees, allowing both employee and employer contributions. Employers can either match employee contributions dollar for dollar up to 3% of compensation, or make non-elective contributions of 2% of each eligible employee's compensation. So a simple IRA, somewhat similar to an SEP, but the big difference between the two is that SEP, only the employer can contribute, whereas simple, the employee and the employer can contribute. Keogh plans are suitable for self-employed individuals and unincorporated businesses, and they offer higher potential contribution limits and can be structured as either defined benefit plans, providing a fixed annual retirement benefit, or defined contribution plans, such as profit-sharing plans. And again, you're more likely to deal with defined contribution plans, but I just wanted to make sure you knew about both of them in this video. DPSPs allow employers to make discretionary contributions based on the company's profits, with the maximum contribution being the lesser of 100% of the employee's compensation or a specific dollar amount, again, for example, $66,000. So overall, while SEP and simple IRAs are relatively easy to administer, Keogh plans and DPSPs often require more complex setup and maintenance, potentially involving actuarial calculations and annual reporting. So we learned about a whole bunch of different retirement accounts, and that closes our short group of videos where we talked about all the different retirement plans for individuals. So just remember, Compare the retirement plans in this video to the retirement plans in the other videos so that you can kind of know the advantages and disadvantages of each for the CPA exam. And with that said, that's the end of the video. Make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. Again, we teach the key ingredients to passing the exam. It'll only take an hour of your time, and you will learn a lot about how to improve your process. The link will be in the description. Also, if you liked this, we only went over 5 questions, but you can get more of it by becoming a Superfast CPA member, because Superfast CPA members have access to the full 10-question video when we post it in the members forum. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.